Thank you, Kevin, and good afternoon, everyone. It's great to be back at the London Marine Money back in January, where it ought to be. The presentation today, as ever, there's a lot to get through. The title is What's Next on the Horizon for the Shipping Markets, Storm Clouds or a Pot of Gold. What I hope to do over the next 15 minutes or so is just give you an overview of the markets, the underlying drivers, our assumptions and how we expect them to develop over the course of the next few years, and in some instances some more strategic changes we expect to see over the medium to longer term. To start off with, what I'm going to do is just give you a sort of helicopter view of the market, looking at some of the fundamentals, a relative health check, comparing and contrasting sectors. I thought I would just put up one macroeconomic slide because I think it's quite important just to emphasize the headwinds that the industry has been facing over the course of the last 2 to 3 years. In many instances, we're seeing sort of a sawtooth profile from some of these chief macroeconomic indicators. Other times we're seeing very elongated, stretched peaks in things like commodity prices and inflation. But overall, the industry has performed, as ever, reasonably well. If we look at this from a pure cargo perspective, and what I've done here is broken down commodity flows by all the major shipping types, we can see in 2022, certainly for gas, car carriers, and the oil sectors, we saw positive cargo growth. For dry bulk containers, as we said this time last year, we were starting to get a little bit worried about those two sectors. In chemical tankers, again, we saw low trade growth last year, primarily due to the Russian invasion of Ukraine and the zero COVID policy in China. Looking forward to 2023, as you can see across the board, we're forecasting positive cargo growth. And in many instances above and beyond the sort of 10-year averages. So a relatively positive picture from cargo growth perspective. On the supply side, last year, supply growth was relatively benign across all of the sectors. We saw sort of low single-digit territory year-on-year fleet growth. We're seeing a very different picture across the sectors in 2023. This is factoring our assessments of slippage, cancellations, and scrapping. And you can see for tankers and bulkers, it will be marginal fleet growth, if that. For containers, for the gas carriers, this year we're going to start to see some of that large order book that's built up over the last 2 or 3 years start hitting the water. That's going to cause concerns. If we try and pull together our fundamental supply-demand balances, I've put 2 charts together here, or almost infograms, to try and emphasize the difference we're expecting to see, or we've seen in each of the individual sectors. The chart on your left, as you look at it, fundamentally what we're doing there is just looking at those headline cargo growth against headline fleet growth. Anything in the green section has been positive for the market, so that's where trade has been bigger than supply. What I've then done, and anyone that's listened to an MSI presentation, certainly over the last 18, 24 months, will have heard me or my other colleagues talk about the inefficiencies and how you really have to look at the inefficiencies to really work out what's going on from a fundamentals perspective. So the chart on the right tries to capture this. What we've got there is shipping demand. So that's factoring in the inefficiencies that we've seen in the system and available supply growth. So that's also factoring in taking out those vessels that are operating in long-term storage or vessels that aren't able to trade. And you can see you get a very different picture. We're now seeing dry and the container ship sector way over on the left-hand side of the chart, so very negative in terms of market balances. A few more sectors have moved into the green shaded area, and the interesting one from looking at the available supply perspective has been the chemical tanker markets. If you remember the chart, or 2 charts before, we saw decreasing chemical cargo flows. We're now seeing shipping demand in the positive territory. Available supply has been very negative, and this is because a lot of the swing tonnage, that can trade products or chemicals are now trading products, with it being strength in that market, and that's reduced the available supply for the chemical tanker markets and given it a real lift. And yes, I have included the infamous "where are we on the cycle" slide by popular request. Things have changed a lot since I stood up here in April at the last Marine Money London event. I'm going to start from the right-hand side, from the positive area. We're seeing huge strength at the minute in the car carrier sector, the chemical tanker sector, and there may be a little bit further to run. If we move to the left, we've got the offshore sectors. We're finally seeing some positivity in offshore. With some relatively long runways, we do expect to see this market continue to improve for some time to come. Containers, dry bulk, as I said this time last year, we thought they were on the way down, and our forecasts have come to fruition. And on the far left-hand side, we've got everything else, which has passed the peak of the market from an earnings perspective. However, I would want to just make one caveat to that. For things like the gas sectors, for the tanker markets, we've seen levels of earnings come off from their peaks, and a lot of those peaks were driven by the froth and sentiment in the markets. There's still strength from a fundamentals perspective. We're just taking off some of that froth, and earnings won't be at the levels that we saw perhaps at the end of or during Q4. If we look at the sort of 12-month on 12-month position, we can instantly see the winners and the losers, car carriers, oil tankers from earnings and a values perspective. And at the bottom of the table, we've got bulkers and container ships. And is there still cash in the system? Is there money to pay equity holders, to shareholders, etc.? So this is our assessment of break-even levels against the one-year TC rate. You can see bulkers at today's prices, it's marginal, but for everything else at today's values, the one-year TC rate, there's still a lot of headroom between break-even and one-year TC rates. What I want to do now is just sort of move over into some sort of broader themes on the demand side picture. And we've heard some positivity this morning around the Chinese market. And I think in the short term, yes, we will see some positivity. The one thing I would want to say from a more structural and strategic perspective is that China is not the China that we knew 10, 15 years ago, where we were constantly seeing double-digit growth across a range of commodity imports. These are just 4 slides that I've put up just to try and get a measure of what's going on in China. The first one here is Chinese residential properties sold and properties started. Yes, zero COVID will have played an impact in some of those numbers last year, but you can see there's sort of a plateauing that we've seen over the last few years, even before COVID. Steel output, iron ore imports, the growth is not what it was. If we move on to the oil sector in the bottom left, we can see there in terms of number of Chinese refinery starts, again, we're getting into low single-digit growth. And then finally, in the bottom right-hand corner, what we have there is Chinese exports as a share of GDP. So China, the growth in exports isn't going up at the same levels as we've seen before. So China, I think, will still grow, but not at the rates that we've seen. And this was touched on in a couple of panels this morning, and this is a longer-term perspective when it comes to China and our concerns potential in the dry bulk market, is the rate of urbanization in China. It's at around 64-65% at the minute. The goal is to get somewhere between 75-80%, hopefully, by 2035, but it will slow down. G7 countries, 81% on average. So over the next 10, 15 years, we're going to hit urbanization peaks within China. To sort of what makes it even worse from a sort of iron ore and a dry bulk perspective is that move towards using recyclable steel within China. And you can see our forecast in the chart on the right that shows by 2030, we expect to see a lot more steel being recycled in China and being used to manufacture new steel. That's obviously a double blow for the iron ore market and the dry bulk, certainly the large dry bulk carriers. The other point I just wanted to sort of bring to attention and again, we've talked about it a little bit today, is the changing dynamics, the changing trade routes that we're starting to see across lots of sectors of shipping. I've put up the oil tanker market just as it's one of the sectors where we've seen the most changes most recently, whether that be driven by the Russian invasion in Ukraine and the exports of Russian barrels east, and Europe having to source barrels from further afield, as we can see in the top left. The rise in the commodity prices, which has made a lot of shale once more viable. We're seeing a lot more crude coming out of the US. That needs to find a home. As we can see, a lot of that is also heading east. The developments in the Middle East in terms of refineries. The Middle Eastern economies are looking towards starting up new refineries or starting refineries, getting more value added out of a barrel of oil. So rather than exporting crude, they're going to be exporting products. That's changing the dynamics. And overall, what the thesis in the tanker market, and we expect it to run for some time longer, is that we are going to expect to see oil moving on the longer distances, more ton miles, which is going to be great from a fundamentals perspective. It's not just oil. I thought I didn't want to be too oil-centric and just prove that other sectors were seeing something similar. So here's a chart on Western Europe coal imports. Implemented a lot of these changes by the ban on Russian imports of, European imports of Russian coal, but we're seeing more coal coming to Europe from places like South Africa and Colombia, and also LNG. There's a rejigging of the LNG markets also. So that was demand. I'm going to quickly move on to supply. Contracting over the last couple of years has been significant, especially if we look at container ships and gas carriers. This is our forecast as well. You can see going forward, we don't expect to see huge volumes being contracted this year. They will start ramping up as we get to the middle of the decade, and it will be a lot more of an even spread between sectors. But just to give you a flavour of how much contracting we have seen and some relative measures on the container ship sector, what we've done here is we've looked at the order book for tankers, bulkers and containers. We've compared that to the fleet in terms of a percentage, and we've compared it to a ratio of those vessels over 20 years old. And we can see that for the big container ships, you know, the order book as a percentage of fleet is over 50%. 4 times greater than anything over 20 years old. So there's some big concerns there. And you can see the other sectors of the container industry that are also overexposed to the order book. If we zoom in, and we've had to zoom in to try and make a little bit clearer, you can see just how low the order book is for a lot of other sectors, especially the tanker sectors and the small bulker sectors. So positive from their perspectives. Now, one of the reasons, of course, that we haven't seen those ordering volumes, and this again has been talked about a little bit this morning, is just the general uncertainty over what technologies to order, what fuel types will be the fuel types of the future. This is just a breakdown of orders quarterly by fuel types. And we can see for containers, actually, we've seen huge take-up in the last 12, 18 months in alternative fuels. Now, that's fundamentally 2 reasons there. One is that the container ship market, as we've heard before, is close to the end consumer, so there's a lot more pressure there. 2, container owners, the liners, have just had so much money, they've been prepared to, in some sense, take a punt. On the dry bulk, by comparison, we can see that the uptake has been very minimal in terms of alternative fuels, alternative technologies. So what that's prompted us to do at MSI is try and work out, can the industry ever get to sort of goals in 2050 that the IMO set, or net zero by 2050, which is the new one that we're starting to hear more about. So we've built some internal models which look at the replacement requirements of tonnage, looked at by sector, by subsector, where those vessels trade, and the potential take-up that we expect to see across the board to get a broader sense of what fuels there will be in the future and where those fuels will be deployed in terms of asset types. And you can see it's very different if we look at something like a small bulker compared to the large container ships, where we've also already seen a big take-up in alternative fuels. And the reason that we wanted to do that was, well, yes, it's interesting. We want to know the fuel requirements, but then we want to start running some economics. When will it make sense from a purely economic perspective, given our views and more of a consensus view over the future price of green fuels, the future price of carbon pricing, when does it make sense from a purely economic perspective to switch to green ammonia, to switch to green methanol, versus just running on low sulfur fuel oil as many are today? And unfortunately, just from a pure economics, no regulations. We heard in James's panel earlier that regulations will be key, but from an economics perspective, it's not until around the end of next decade that it actually becomes more economically viable to run green fuels than it does LNG, conventional fuels, or fuels with a scrubber. That's a concern because, you know, we know in this industry that unless it's regulations, the industry operates on economics. And people won't, in some of those like handy bulkers, won't necessarily switch to alternative fuels. If we only start switching in 2040, we're going to be way too late to meet any deadlines by 2050. So it is important that we see a lot of corporate goals, we see green corridors, so we start generating some of the fleet with utilizing or has the ability to utilize low carbon fuels. And we do think we need this trickle-down effect. The tier one operators, owners ordering today's technology, so they can then, those vessels within 5-8 years will end up on the second-hand market, that can go to tier two owners. And by the time we get to 2050, the industry as a whole may have some chance of hitting the 2050 targets. Finally, I just wanted to cover the second-hand price market. Prices in general, asset prices have had a lot of support over recent years from new building prices. The yards are filled up, as we've talked about. Costs have gone up. That's enabled yards to put prices up, which has helped lift up second-hand prices. We've started to see new building prices tilter and come off. Certainly for some sectors, dry bulk, we've sort of started seeing that towards the end of last year. Others have started plateauing. We do think in terms of costs will continue to decline this year before we see something of an uptick next year. Yard forward cover, as you saw, our contracting forecast, we haven't got a very strong contracting forecast this year. Deliveries will outpace new contracts. That means yard forward cover will go down, which means that the yards will start having to lower prices to attract new orders. So you can see our outlook for new building prices in the chart on the right, whereby, you know, we're expecting to see a drop in new building prices and then to trough in 2024 into 2025, depending on the sector. From an earnings perspective, which of course is the fundamental, along with new build and scrap price driver, earnings, this is just a distribution of historical earnings, and what I've done here is just plotted whereabouts today's earnings are for these 6 sectors. And also the red is our forecast for 2027. You can see for that top line of assets, the bulkers, tankers, VLCCs, we're actually forecasting earnings to be stronger in 2027 than there are today. Tankers a lot further along and towards the sort of top end of the historical distribution, whereas bulkers sort of more aligned with history. And down the bottom, you can see that containers, as containers come off the sort of highs that we saw last year, we don't think they're going to be near today's levels, but not down at the levels we saw in 2015 and 2016. Gas somewhere similar, and MPPs slightly lower. So bringing all that together, and as I traditionally end up at a Marine Money presentation, what I've done on the next slide is do the classic IRR, where is the best investment to be had currently in shipping, based on MSI's latest Q4 forecasts. The analysis here, run through all our models, run through our FMV product, and what we've done here is we've looked at buying a 5-year-old asset today or a 10-year-old. So the 5-year-old is the dark blue, the 10-year-old is the yellow, and we're going to keep that vessel until 2027 and sell it in 2027. and look at the cash flow associated with both the sale and purchase and also the earnings over the interim period. And you can see, without doubt, at the minute, the sector where we're most bullish is offshore. As I say, we do think offshore has got quite a long runway to go, given where the market is, given how low the order book in that sector currently sits. And then tankers and actually small containers. Small containers might have surprised me a little bit when I put this together. But as you saw, the order book for those sectors, it remains very low. And at the bottom, you can see large containers and some of the dry bulk carriers is where we think there's only going to be marginal returns over the course of the next 4 to 5 years. So thank you very much. I'll be around if anybody has any questions.